My name is Youssef Sharif Wilson. I am in real estate as an agent, and I also do consulting in law. My background is in law. One goal that I set at the beginning of the year to accomplish that I have not yet reached is to have 2 rental properties by the end of this year. I've had a couple opportunities, but I was just telling Joe I'm trying not to buy them at retail. So there is the process of trying to navigate through that in order to get that, in order to succeed at doing that. So these are all off-market plays, if you will.
Okay.
But those are.
It's not a bad goal.
Goal.
You're not trying to buy 10 properties. You're trying to buy 1.
2.
2. Okay.
Yeah.
Well, you're aggressive.
Trying to acquire 2.
Acquire 2 more. Okay.
So I am a web developer, software engineer, and I teach. And the goals that I set at the beginning of this year was to get myself into a multifamily, live in one part and rent out the other. So typically called home hacking. My name's Paul, if I didn't mention that already. And yeah, that's.
We're just going to make up a name for you.
Yeah.
Michelle.
Hi guys, this is Michelle, and the goals in real estate, I guess doing more investing in the Philadelphia market. I have a friend, business partner that I work with, and we want to obtain a little bit more residential units in the Philadelphia market.
Excellent.
Hey guys, Pierre Street. I still work in finance in New York, and half my time is spent rehabbing properties in Philly, and the other half is private lending in Philadelphia as well. And I also recently took on 2 clients looking to allocate about $50 million in Philly. So that's pretty much what I do.
My name is Anna. Currently, I investigate IT sector in order to bring the Ukrainian services to American market.
Excellent.
Hi, I'm Ricky Brava. I've been in the mortgage note space for over 8 years. Buy, sell, and trade mortgage notes nationwide, and I also have different endeavors. Basically, I work with private equity with alternative investments, whether it's funding films or other things.
Hi guys, my name is Charles Seaman, and I've worked for a commercial investor for the last 12 years. And a personal goal I have for myself before the end of the year is to buy a multi-family property with investor money.
Hi, my name is Joanne Thomas. Well, this is new to me. I got into this business because of my sister. She got into 14 Builders Mastery Program like a year ago, and she has flipped 3 homes. So I just started with 14 Builders myself a month ago, and I'm interested in investing, and I'm here to build my team. I'm starting. This is my first real event, so I'm just new. I'm just here to learn and grow.
That's great.
Yes.
Joe Scarice, First Trust Bank. I've been a loan officer since 2001. I've been a licensed real estate agent since 1987 in New Jersey and PA. Start buying in '94. Own a portfolio of close to 60 doors with my brother and my sister. I don't take any profits from it. The money goes toward one of my nephews that was born handicapped. So I don't need to take a paycheck on that, thank God. Haven't taken one since '08 when the mortgage industry crashed. Owned properties up in the Lehigh Valley area, sold all those. Moved to Philadelphia 8 years ago, got married, remarried and married, and basically own now about 20 properties, all in different phases of development, cash flow, multifamily. I private lend on money, which is a nice luxury to have, to be able to crowdfund money and put it to work on primarily rehab or gap funding. And a goal that I'm setting up for my real estate sales group, which is called Your Town and Country Real Estate. I have about 25 realtors that work for me, and a property management company called Philly Managed. I'd like to see those grow by 30%, meaning whether in staff or doors. or sales over the next 6 months. We just had a big meeting today, and we plan on bringing in over 20 realtors over the next 2 months to double the size of our real estate office. So I'm setting some very, I would say, aggressive goals for growth outside of just lending, but more the whole real estate component. Also, I'm a proud owner of a wellness center and a school of massage therapy with my wife, which also hosts a Reiki school, and that's in Center City at 1500 Chestnut. We own a space roughly around 8,000 square feet at 1500 Chestnut, right below the Ellington, which is a luxury condo building. And my wife runs that. I don't give massages, so if anybody's looking for one, you're out of luck. But we've been open for 3 years. We have had over 100 students come through in 3 years. So I'd like to see that do all that within the next year, but that'd be a nice goal just to keep the business rolling. So that's pretty much it. And I'm glad everybody had an opportunity. Just kind of didn't feel good about putting out a goal. You know, there's a transformation to that. You know, it humbles everybody. It puts everybody in a different perspective for their business. Everybody here is more than welcome to attend a event, whether in Delaware or Philadelphia or South Jersey, where I host a group of events. They all average in size anywhere between 20 attendees, as high as about 50. We just had a big workshop a couple weekends ago about Act 135, which is a statewide recovery of blighted properties, where you can go through the legal process and recover blighted properties that are out there in the state of Pennsylvania. Had over 145 people there, and we raised $1,500 for our soup kitchen down on Kensington Avenue called the St. Francis Inn. So it was a lot of fun, you know. So those are old stomping grounds of names that you're probably remembering some of the areas. So I met Michelle through obviously seeing Jay and you online, and we were connected for some reason on Facebook anyway.
Facebook, LinkedIn,
yeah.
There's quite a few platforms.
But your network is your net worth, so it all becomes full circle. We had a conversation. I then introduced you to Yusuf and Charles, and I thought maybe it'd be nice to do a podcast from a Midtown Manhattan type of environment. And I wanted to come up and just formally meet you. And I know you're coming down to Philadelphia in a couple of weeks, so I had it marked down. But depending on your accident here now, it might change. I would assume.
I'm going to push through, and it's August 19th.
Yeah, I have it down for
Yeah.
some reason that we're supposed to meet, but I don't know the logistics of it all.
Yeah, I'm going to head down there. I'm going to have a discussion with a couple of other real estate brokers,
Okay.
and kind of capture the essence of Philadelphia, because Philadelphia is a great market, and I just want to bring that awareness out to other investors or people that are looking to invest.
It's absolutely very active right now. House hacking, forget about it. Everybody's buying a multifamily property to live in. The inventory of a multifamily property is down 40%. The bank REO listings are down 40 or 50%, all the bank REO listing agents. It's a wonderful market right now, and you have a completely undeveloped waterfront for 400 acres along the Delaware. It'll be Weehawken one day, but right now it's crabgrass for motorcycles, quads, and the bad elements of Philadelphia as well. So I'll leave that, more generically, but I think there's a huge 20-year play in the market there, whether we have a slowdown or speed up. Inventory is low because nobody that lost money in 2008 on their equity in their house put their houses back on the market that had equity for the first time in 8 or 9 years. So very interesting timing down there, but it'll be an exciting opportunity. But yeah, the floor is yours. I don't think we're going to have much more people from the humidity and the wonderful weather we've had today. And maybe you want to kind of just start your interview and go from there.
Do you want to do a quick intro for him as well?
So we're doing 30-second elevator pitches. Okay. Who you are, company name, and a goal that you'd like to accomplish before the end of this year.
My name is Floyd Bazin. I'm a private investor. I invest in single family, 2 families. I do fix and flips, buy and holds. By the end of the year, I'm looking to have a few more properties in my portfolio as far as multi-family commercial units. And what else did you ask? I'm sorry.
Goals.
The goal for the end of the year, I think you kind of went over that. Where are you buying? What market are you buying?
Right now, I'm in the New York market, but I'm looking to be anywhere that the numbers make emerging markets, and looking for partners and funding.
Okay, excellent.
Yeah.
Is the camera where they can
Yeah,
really
yeah,
see me
yeah,
the whole 9 yards?
yeah.
Okay. Hi guys, this is the Working Money Podcast with host Michelle Wong. I'm here at the New York and Brooklyn RIA. Joe, thank you for having me.
No problem. Pleasure.
I have Joseph, I have Yusuf, and I also have Paul. Charles unfortunately stepped out for a little bit. They're the organizers here for the RIA. I also have guest host Ricky Brava. Hi Ricky. And basically we're just gonna have a Q&A session with everybody here, talk about a little bit more about real estate, discuss alternative investing as well. And let's take the floor. Ricky?
I'm
Wanna
talking
get-
now?
Yeah.
What is it? All right, so like I said, any of you guys are interested in the mortgage note business, feel free to just ask me any questions. I've taught that subject matter for many years now. So
I don't know the listener base, but can you just go through from baby telling it to your grandma how this stuff works?
okay, yeah, sure.
An overview.
Like one of those "What do we do" videos.
Yeah.
So how do you buy a house? Usually, traditionally, what does the American person do? They go to the bank, right? And they what? They get a loan that becomes the mortgage. There's a note attached to the mortgage. Now that's the instrument of debt that's has the lien on the property, right? Good. So ideally, the homeowner pays as scheduled, and there you go, right? But not most of the time, sorry. A lot of times they do, unfortunately, default on the mortgage. That becomes quote unquote taxed asset, bad paper. There's many different names on the streets for it. Let's just call it not performing mortgage notes. Bank originated not performing mortgage notes. Now, a savvy investor can go ahead and buy those notes at a steep discount. To give you an example, now remember these numbers are nationwide numbers, not Manhattan numbers, right? So if the property is worth $100,000 and the debt on the property is like $140,000, for example, right? Because they defaulted for a while, you can maybe pick up that mortgage note at $50,000. Depends on what area, $60,000, $40,000. So you see the spread that you can make. So what does that mean? If I buy it at 50, the house is worth 100, the guy owes 140. I can now start to service the loan, meaning try to work something out to get the guy to start paying on his defaults and everything and make his mortgage note current. Meaning now what just happened? I created a cash flow, which is a big buzzword in real estate, right? I want a cash flow property. I'm buying rentals that are cash flow properties. But the only problem with that is that you're a landlord. When you cash flow as the note holder or the owner of the note, you're cash flowing as the bank, meaning you don't have the liabilities of a landlord. Plus, because you bought it at a steep discount, your return is well over 10%. So you're cash flowing. You could cash flow at 15% with no liabilities attached to your cash flow because you're the bank. You don't have to fix and make any repairments. If it snows, you don't have to shovel. You don't have to deal with that. That's what the homeowner has to deal with. So there's levels, right? There's the renter, the homeowner, the bank. When you buy mortgage notes, you are in this level. You're the bank. So that's a scenario. That's an ideal scenario, right? Because you work something out with the homeowner, you created a cash flow as the bank. Another scenario is you couldn't work something out with the homeowner. Now what are you going to do? You have to protect your investment, so you use the legal recourses that is allotted to you by the law, meaning that you could foreclose on that property depending on what state. That would give you the timeline of foreclosure, right? If you need to foreclose on a property in New York, it could take you 3 to 5 years if you're lucky. If you go to another state, you can do it in under 3 months. So you understand? So that's why it's ideal to go out of state. So then you take over the property that's worth 100. Now you created what? REO, right? You guys are familiar with REOs, real estate owned. People buy REOs, right? At a discount because they're discounted. But now you're the bank. You took over the property through foreclosure. You have an REO, now you're going to go ahead and put it for sale for the REO investors. You're not going to sell it at 100. You'll sell it at 70, 80 because you just want to blow it out. The paper business is not to hold on to real estate. It's just to use that as your safety net and use the paper side of it as your instrument of profit. So you see how you made money, right? So if you bought it at 50, you foreclosed, and now you sold it at 70, 80, and you got it in and out of a deal within 12 months, you see your rate of return is well over 20%, right? So those are the two scenarios. If you buy a first position, no. Obviously, that business, you have to make sure you buy properly, meaning that you have to do your proper due diligence before you purchase, because you have all the so-called bad news before you buy, meaning how much taxes are owed, if indeed you're buying a first or a second. When you buy a first, what's important is the value of the property, the asset, more so than the homeowner. Like when you're buying seconds, what becomes important is not just the value of the property, but the homeowner himself. Because his credit score, what he's doing. When you're buying seconds, you're gonna focus more on the homeowner than the property. When you're buying first, you're gonna focus more on the property. Both, when you buy first or seconds, they're both incredibly profitable. Some people gravitate towards first because they like to have full leverage. Some people gravitate towards seconds because you can get in at a smaller entry capital point, and the returns could be really high, right? Because you're buying it so cheap. And there's different personalities for different things. Some people buy both. They're both really good. Again, the most important thing to do is do proper due diligence before you buy. It is out there. The business is out there. Like I said, I've been doing it for over 8 years. It could be very lucrative. You'll easily make, if you're doing things right, from 10% to 40% on average ROI. Yes.
Why would a bank want to sell a 40K debt for 60K? My first question. Mm-hmm. And how do you determine, or how does that 60K price get determined? Like why 60?
Well, that's what the market is, right? When the pricing changes, right? When I started buying notes back in the day, I could buy seconds at 5 cents on the dollar, 10 cents on the dollar. Mm-hmm. Now seconds are selling for 40 cents on the dollar, or something similar. When I started buying, I could buy first position notes at 20 cents on the dollar. Mm-hmm. Now they're selling at 60, 70 cents on the dollar. So it's the market's determining. More and more people. It is a very niche market, but more and more people are becoming aware of it. So right now, maybe if you heard it for the first time, you said, "Holy, wow, this is a great idea. Let me get involved." That dictates the market. What people are willing to pay today. If someone wants to buy, mind you that the business has always existed. You could pay premium. You could pay 100% of the loan amount. Mm-hmm. People do that if they have an ideal property that they want to control. So that the market dictates the pricing, and also what makes sense for the institution to let it go at right. a certain price point. Right. That's an internal thing that they figure, okay, if I let it go at 20 cents, I'm still okay. If I let it go at 50 cents, I'm okay. I just wanted to get it off my books. So, see, what people don't realize is that the banks, lending institutions, are not in the real estate business. They lend on real estate, but they're not like the fix and flip guys. They're not the rental guys. They're not in the real estate business. They're in the lending business. They don't want to deal with foreclosing. Fine. And this whole bank-originated note business really got kicked off in 2008, right? Which what happened in 2008? The crash. Mm-hmm. So what happened? What happened to the banks? Did the government bail out the banks?
Right.
Correct. Now, mind you, the government didn't bail out the banks, so the banks cannot foreclose on American homeowners, right? So now those bad loans go to other larger hedge funds and institutions, mm-hmm. nameless institutions. That they can foreclose on American homeowners.
Right.
So, you see? Mm-hmm. So that there is a marketing side to it as well. And on my end, I say don't judge of why I'm selling. Just judge if the numbers make sense to you. Mm-hmm. Is the profit there for you? Don't worry about why a guy is selling.
Right. So for a guy like me, retail, looking to get into the mortgage note investing,
Yeah.
would you suggest me having a relationship with you, or because I've seen stuff online where you could bid on,
Yeah. Okay.
notes, first, second,
The
third.
dark side of the mortgage note. I have a profile on LinkedIn, but I never use it. Just so
Yeah.
you know, it's been there for many years. I rarely check it. I should update it, I guess. But I'm never looking for a job, so I don't care. So I would stay away from buying from someone on LinkedIn a mortgage note.
No. There's a marketplace. It's
There's a
called
marketplace.
FCX Exchange.
Okay, there are some that are reputable and some that are not. You probably said FCI.
Yeah, something like that.
FCI is reputable. It's been there for many years. That's a servicing company. They service mortgage notes. I've used them. They have some of my loans. So there are different marketplaces. Yeah, you could. What happens there is that now you're really paying retail.
Okay.
You understand? You're really paying maximum. They're asking for things that don't really make sense sometimes. You could still find good deals, but you really have to look through.
So where do I get the discount?
It's a relationship based. I mean, you know me. If I have something for sale, I can facilitate,
Gotcha.
and sort of handhold you through that process. What I've done for all my mortgage note life is that I've handholded everybody through the process, through the first few loans.
Right.
That's for free. That's not my goal, right? My goal is for you to be profitable. Why? Because you're gonna turn around and buy more notes from me. And not just that, but you're gonna turn around and ask me, Ricky, what else you have going? And then I'll tell you, no, today, listen, I'm funding this film. I'm funding this startup. I'm funding this oil and gas deal, and for different things. So for me, obviously, I can do, if I do a really bad job on a mortgage note purchase, I'm making 10%. I did a bad job. You made 10% return.
Do you acquire these notes in bulk?
From time to time. There's what they call offerings. Some banks have offerings like 3 times a year, and then you do have to buy in bulk. Or you could buy just a couple at a time.
And is that
If you deal with me, you don't have to buy in bulk, you could buy one. You understand? When there's an offering, when I really hit the mortgage note business hard, then I look at bulk stuff. But right now I'm waiting for a fund to be cleared by the SEC. That's going to be just based on mortgage notes, right? When that comes out, it takes a lot. It's been taking a long because it's a Reg A, Regulation A, not a Reg D. Regulation A, I can use non-accredited investors to invest in the fund, which is amazing. But it's taken a long time. If it ever does go through with the SEC, then I'm going to hit the mortgage note space hard, or maybe train someone and have them be the CEO of that fund, because I'm busy in other things right now.
So the investors who are buying over $1 million have to be all accredited? Or like what's the threshold
Okay.
for?
There's many ways you can do. You could buy your own notes and you could process them yourself, which is you're gonna make the higher rate of return, or you could put your money on a fund. There's many different funds that deal with mortgage notes. Right now, you should be accredited to invest in one of those funds, a Reg D fund. I don't know what they offer. Sometimes they offer 10% plus a split of the profits. Different funds, different things. Think of it as just a traditional real estate fund. Instead of using fix and flips or rental properties, they're buying mortgage notes.
Can you offer a profile of some of the typical end users, the end buyers, rather, of these notes? Are they individual investors? Are they?
Yeah, they come from
Bunch of
all walks
guys
of life.
getting
No.
together.
Okay. What my experience has been, it's like you have individual investors. They try it out, get their feet wet. The realization that this is a real business and it works and it's legal says, okay, everybody has a different starting point. Some guys just say, okay, I'm going to just buy a couple of assets and thread slowly but surely and build my own portfolio. Some guys get aggressive. I'm going to tell friends and family and I'm going to put money together and then I'll see and we're going to buy as much as we can, and then you start working those assets. In fact, they become fund managers at that point. So there's different ways you can do this. It's very attractive because the main thing that makes mortgage notes attractive is the security on investment, which is, I think, the most important thing about investing in general. Someone asked me, what's the most important thing in investment? Security in investment. Don't tell me it's the rate of return. It's the security first, then look at the rate of return second. That's what makes mortgage notes attractive. It's very secure. But you got to buy right. It's like anything else. You got to buy right. If you buy right, your money is secured by real estate, and you have plenty of maneuvers and exit strategies to be wildly successful. That's the mortgage note.
So can you offer an example of a situation where it wasn't purchased right and the situation where it was?
Okay. Yeah, I'll give you an example. Not me, but when I was facilitating a liquidation for a bank, I am personally not in charge of looking at every single asset to make sure that every single mortgage note is a good one. But if you're already a savvy investor, you say, hey, Ricky, I want to buy this loan, this loan, this loan, this loan. No problem. How much you're offering? Okay, good. These offers got accepted, right? Send in the bank wire. By the way, this business is done through bank wire. There is no closing table. These are all bank wired business. So that's the thing that you have to get accustomed to, which is very different. Things are fast. Like I told a gentleman before, when you do due diligence, 3 to 4 business days, you should know if you can buy a note or not. That means what? You say, I want to buy it, this is the price is accepted, they send you a purchase sales agreement and bank wiring information. It's not just me, it's the industry standard. You wire the funds to the bank, and then you should get your collateral package, meaning your original note, mortgage, assignment, and a launch delivered to you and assigned to whatever company it is that is yours. And
what's an allonge? What is that?
The allonge is how you send this note. When I sell you a mortgage note, the assignment's attached to the mortgage. Right. The allonge is attached to the note. Okay. It's an assignment. An allonge is an assignment, but not for the mortgage, but for the note. Remember, there's 2 instruments, right? Okay. That's what an allonge is. One has to be.
How do you spell that? Allonge.
ALLONGE. Okay. One has to be notarized, which is the assignment. The allonge does not. Mm. Some states don't even need it.
The note is what you're buying, right?
You're buying both. You're buying the mortgage note. The mortgage and the note.
The mortgage followed with the C, and the note is actual note with the
every mortgage has a note, right? Which gives the notice a simplification of the terms of the mortgage. You know, right? That's what that is. So those are those instruments.
And you mentioned the opportunity to buy from at an auction from the bank. How do I find out where?
Yeah, like I said, it's relationship based, and that's not going to be available to you. Seriously, no, because one of the auctions that I have to have proof that I have a $20 million business to be allowed to.
So you can't just go into any bank.
No, you can't. Well, go ahead and have that experience. What they're going to say is, no, we don't sell notes. What are you talking about? You can call them. No, we don't sell notes. Now, obviously, and then there's people that sell courses who say, hey, you can call the bank and try to get them to sell you notes. It has happened that you can get through to the asset manager of an institution and tell them to sell you the notes. A lot of time, but you're not going to get them at a discount. So a lot of times a bank will say, oh, okay, this is a non-performing note, but I want you to pay the full price. You wouldn't do that. You want to go to the banks or financial entities that will sell it to you at a discount.
So the numbers are good and you do your due diligence and everything's right. What are you looking in terms of like ROI?
Yeah, the standard is between 10% to 40%. Because you know what you can control is the security. What you cannot control is so much the outcome. This is going to be if you buy it first, there should be 2 outcomes. Either you get the note to reperform, so now you created the cash flow, or you have to take over the property and now you own a property and you sell it as an REO, for example. So that's why it varies, the rate of return. Now, when you buy a second, your strategy with a second, you can make 10 to 80% return if you get the homeowner to agree to start paying you on the second. You can also foreclose from a second position, but the numbers have to make sense. You have to have a lot of equity to do that. If not, you're doing something wrong. You shouldn't foreclose if you don't have any equity, right? Because you're going to be responsible for the first and the tax lien. So that's between 10 and 40 on a first, and I guess 10 and 80 on a second.
What's
like
the
to
lead time
ask,
to this too? Like, say, I know that it's going to be a very fast turnaround because it's a wire transfer, but
Yeah.
in terms of like actually holding on to the note and seeing that it's going to make that
Money?
ROI and
Okay, depends on what state you buy. You get non-judicial states are usually faster than judicial states, obviously. Southern states are lender-friendly. You're gonna go to lender-friendly states because you would be in and out of a deal in 6 months, ideally. Right. Remember, like, you're gonna have an attorney or a servicing company manage these loans. You're not gonna manage it yourself. You're not gonna be calling the homeowner yourself. Plus, because you're not licensed to, right? So it's a very hands-off business. All you have to do is set up your team, meaning your servicing companies and or your attorneys. When you deal with me, I can give you all of that. My back office is yours. All the attorneys I use, you can use, or you could use your own. That's totally up to you. I suggest you use the ones I tell you because they're in the business already, right? But I don't control that.
I have a question
Yes.
for you. Based on what I'm hearing, wouldn't the first dictate the terms of like when they foreclose or if they foreclose, or?
But you're the first. If you buy the first, you're
But
the
if
first.
you're right, but I'm saying if you come in as the second.
Yeah, but yeah,
So-
correct. Well, no, because before you buy the second, you're gonna know if the first is current or not. If it's current, right? Remember, you're gonna know all the bad news before you purchase. So whether you buy a first or a second, you know if the taxes are current. And if you buy a second, you're gonna know if taxes and the first is current or not current. So that's all gonna change your strategy, and also gonna change the price point of a second. A second with equity where the first is being paid and the taxes are in order is gonna cost you more, right? Because there's security behind that second. But if everything's defaulted, that second's gonna really cost you not much because there's no security behind it, right? The price points really also have to do with security on investment. So.
But if I were to foreclose a second, he would have to be paid first.
Correct.
Right. Okay.
But
then
that's
that
not
goes-
the strategy. When you buy seconds, that's not your strategy. Your strategy
Is the income.
is to get a hold of the homeowner to start paying you. And now you're going to create a large return because you're buying it really cheap. You're buying like 30 cents on the dollar. So you created a cash flow as a second position. Now there's a bunch of people that gravitate towards that. There's some people like myself that I need to have control of my money, so I gravitate towards first. Yes, but I know both. I started in the second position market. Then I shifted to first position when I got more money, right? So it has to do with money too. But there's funds that really crush it with seconds only. They don't do first. They hate it. They like to deal with.
I'm part of Dave Van Horn's network, and I get
he does
emails
seconds,
saying-
yes.
Mostly seconds, yeah.
Yes,
I'm not really.
and he does an amazing job with it.
Yeah.
And I recommend Dave 100%. He's a stand-up guy, and he does really good work. I call him Batman. Yeah, no, it's a personal thing, but he's a really cool guy. Yeah.